time now to welcome on board Mr. Jayant Acharya. He's of course the Joint MD and CEO at JSW Steel. Hi Mr. Acharya, good to be speaking with you. I wanted to begin by discussing the FY25 guidance that you have given for production as well as sales, because that is suggesting an uptick of 6 to 8% only, and that compares with the 8 to 10% growth you have been talking to me about earlier. Are you seeing a bit of a moderation in demand and that's why a bit of a lower guidance?
No, I think we are still quite on that number of 8 to 10% growth in India going forward. Because if you see the last year, the demand growth in India was about 13.6% on a back of 13% plus growth in the previous year. The numbers at 136 million tons last year was a 16 million incremental increase in volume. Going forward, even if you take the Q4 growth, which was about 9%, which was lower because of subdued domestic sentiments, pre-election activity, even then we would add incrementally 12 to 13 million tons in this coming year as well. So on a volume perspective, I think we are good to go. Our capacities are, as you must have read, our hot strip mill in Vijayanagar has been commissioned. The integrated facilities are under commissioning in the next 2 months or so. But as they ramp up, the production volumes will increase. Similarly, BPSL Phase 2 expansions have been completed and they are also going to be ramping up for this year. So you will see the full impact of this capacity expansions coming in the FY26.
Mr. Acharya, talk to us about the domestic steel price scenario. We understand that there is a slide due to imports actually coming and impacting the space. And now there is a concern, added concern of China dumping due to US-China tariffs which will coming in and will be applied. So in context, all of you, how do you see the pricing trends take shape for you?
So I believe that the prices in India have bottomed out. If you see in the last quarter, while the costs were also higher and the prices internationally and domestically also did correct. But having corrected, it has bottomed out and we have seen an increase in prices of steel both internationally and domestically in April, May. But even after that increase, we are where we were 6 months back. So from that perspective, I think we have reached a stable pricing environment. It may be range bound. As far as coking coal is concerned, we see a drop in coking coal. In the last quarter, we had seen an increase in coking coal cost. We had guided $20 to $25 increase between Q3 to Q4. We had an increase of $22, which impacted us on cost, and the prices were weaker, and that had an impact on margin. Going into Q1, we feel that the prices, coking coal prices would correct for us by $22 to $27 a ton. And if this coking coal price remains, which is prevalent today, I think we would see some more benefit going on into Q2. So costs will go down. The pricing will be stable. Some of the cost levers which we have worked on over the last year or two will benefit us, so better efficiencies and cost optimization and higher volume. So that would give us an EBITDA margin improvement.
Okay, so you're talking about improvement in EBITDA per ton, but let me narrow it down a bit more, because this quarter there was a sharp dip to sub 8,000 per ton. Do you see it going above 10,000 per ton, let's say in Q1 itself, or is it likely to happen in the second half of the year, Mr. Acharya?
So if you look at the last 9 months prior to Q4, 9 months of FY24, our normative EBITDAs were between 12 to 12,500 rupees per ton. And we feel that Q1 was something which was more of a stress scenario. But going forward into FY25, we will be in the range of the normative EBITDA, which we have been there in the last 9 months of FY24. It will be difficult to put a quarter-wise number for you right now, and I think the prices do change. But directionally for the year as a whole, I think we will be in that range, as I mentioned.
Mr. Acharya, you've also made announcements regarding a possible fundraising. 20,000 crore capex has also been spoken about. Can you break it down for us? How much are you deploying and how would you be going about it?
The Capex plan spent for this year is going to be 20,000 crores. We would be spending on our capacity expansion. I'm happy to announce also that the board has approved the phase 3 expansion at Dolvi, which would be an incremental 5 million tons of integrated steel production, which will be added. And that should start operation somewhere by September 27. A part of the 20,000 crores of capex which we will spend will be towards the phase expansion as well. During the year, we'll ramp up our capacities in JVML and BPSL. We will also debottleneck capacity in Vijayanagar, which would incrementally add capacities. So overall, in this financial year end, we would be incrementally able to add 8 million tons of full capacity, which will ramp up, and the impact of that will be fully seen in FY26. New capacities which will come with this phase 3 will then come in by September 27. So therefore, going forward, I think we are well aligned to meeting the Indian domestic demand, which is growing very strongly.
Okay, so you're well poised to meet the increasing demand, but also talk to me about any development on the inorganic side of things. You detailed out your capex plan in terms of the expansion, but what about the inorganic route? Because a lot was being talked about, let's say Vedanta Steel business being on the block, NMDC Steel is something that you've already shown interest in. What's been the update on that and the coal assets as well?
Yeah, so on the coal mine side, on the NMDC and electric steel, no new development versus what we discussed last time. However, on the coal assets, we have looked at an asset in Mozambique, and we have agreed to, the board has given a clearance to purchase 100% of that asset. And that is an asset which is a pre-development mine with 800 million tons of JORC reserves. And it's a good mine, which has got prime hard coking coal, proximity to India, and we'll be able to use that in our blend and meet our hard coking coal requirement, which, if you recall, we have been looking at various assets in the world. So on that side, it's a good asset to have. Subject to the normal approvals and pre-conditions precedent, we should be able to close that in this financial year and move ahead to develop the mine. In addition to that, the coking coal mine, we are also developing 3 domestic coking coal mines, which we have got. That should provide 2 million tons of clean coking coal to us. So coking coal, our targets and focus, which we have been having, I think is going in the right direction.
Right. Mr. Acharya, lastly, how have the international assets scaled up for you and the performance of value-added products also?
So the overseas performance has been quite good. For the full year at large, if you see US operations, while Baytown did continuously better, Ohio has been able to reduce their losses. FY24, we saw US operations EBITDA level of $75 million versus $27 million the year before. Italy also posted about 52 million euros of EBITDA in the FY24 versus 26 million the year before. We see operations stability in both these locations, and Italy would continue to be delivering EBITDAs in this range going into FY25 as well. And we expect US operations to do better than what we have done in FY24. Indian subsidiaries have also done well. So overall, I think overseas and Indian subsidiaries both have performed quite well. Our value-added and special products focus has really paid dividends. In the last quarter, 62% of our sales was from value-added and specials. Year as a whole, 61%. And in terms of absolute volume, it has grown substantially. And that's something which is helping us to decommoditize and reduce the volatility in our business, specifically in the downstream areas.
Okay, Mr. Acharya, on that note, we'll let you go. Thanks so much for making time and speaking with us. So, a bit of a recovery in the stock price because the management did highlight that the EBITDA per ton this time around was hit by lower realization as well as higher costs. But going forward, they're expecting an improvement in the coal prices by $22 to $27 per ton. And that means that the normative EBITDA for the year is going to be closer to that 12,000 mark as they had seen in the 9 months of FY24. But
if you like this video, then like, share and subscribe to ET Now.